Here is how the chain works step by step. Step 1. Oil rises. When supply is disrupted, in this case because the Strait of Hormuz remains closed and the US-Iran conflict has no end date, the price of oil rises. Brent crude is above $110 per barrel today. This is not a small move. At $70, oil markets are stable. At $90, businesses start adjusting. At $110, it becomes an inflation event. Step 2. Inflation rises. Higher oil costs flow through to transport, manufacturing, food production, and household energy bills. When oil is expensive, almost everything becomes more expensive. Inflation, which markets had hoped was fading, is now reaccelerating. Recent economic data in the United States confirms this. Inflation is moving in the wrong direction. Step 3. Rate cut expectations disappear. When inflation rises, central banks cannot cut interest rates. They may have to raise them. Traders have now fully removed Federal Reserve rate cuts from their 2026 expectations. Just 3 months ago, markets were pricing in 2 or 3 cuts by year-end. That expectation has been erased entirely. Step 4. Bond yields climb. When investors expect interest rates to stay high or go higher, they demand more return from bonds. Bond prices fall and yields rise. Last week, the 30-year U.S. Treasury yield hit 5% for the first time in 2 decades. Japan's 30-year yield surged as much as 20 basis points in a single session. UK 10-year gilt yields reached 5.15%. Step 5. Equities come under pressure. Rising bond yields compete with equities for investor attention. When you can earn 5% on a government bond with low risk, the case for owning a volatile stock at a high valuation becomes harder to make. The S&P 500 fell 1.24% on Friday and futures are pointing lower again today. The AI-driven rally that pushed global stocks to record highs is now meeting a wall of rising yields.